Hello everyone, and welcome to Lesson 22. I'm Professor Matt with the Fundamental Investing Institute. In this lesson, we're continuing our series on the cash flow statement by focusing on the investing section. Last time, we covered operating cash flow, the engine of a business. Today, we look at how companies invest for the long term. We'll define investing cash flow, break down inflows and outflows, and see how this helps calculate free cash flow. Investing cash flow shows how much cash a company spends or receives from its long-term investments. It helps us understand how a company is using its capital to build or maintain its future earning power. These activities usually involve assets that benefit the business for more than one accounting period. Think property, plant, and equipment, long-term investments, and even the acquisition of other businesses. Now, where does this cash come from? Cash inflows in this section come from selling those same assets. This might include selling a factory, maturity of financial securities, or selling off an entire subsidiary. While positive cash flow sounds good, it doesn't always mean the business is improving. Context matters. A firm might be selling assets because it's more efficient or simply because it's desperate for cash. On the flip side, we have cash outflows. This is the money a company puts to work for its future. Outflows include purchasing new equipment, buying financial securities, or acquiring other companies. Interestingly, a negative investing cash flow is not automatically bad. In fact, it's often a sign of health. It often means the firm is buying equipment and expanding facilities to increase its future revenue. The most common investing outflow is capital expenditures, or capital expenditure. We split this into two types. Maintenance capital expenditure preserves current operations, while growth capital expenditure aims to enter new markets. Capital expenditure is also the key to calculating free cash flow, the cash left over after all necessary investments. The formula is simple. Free cash flow equals operating cash flow minus capital expenditure. It's a critical figure for investors. So when you see an investing cash flow number, the key question isn't, is it positive, but why did it occur? Remember, focus on future earning power, evaluate the context of inflows, and use capital expenditure to find free cash flow. Thank you for watching this lesson on investing cash flow. I'm Professor Matt, and I'll see you in the next beat. In our next lesson, we'll complete the picture by reviewing the financing section of the cash flow statement.